Right now, it's time to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also our very own brand ambassador for the Retirement Income Store and Amazon best-selling author of the book, Turning Financial Planning Right Side Up. We also want to bring in our first guest, an income generation virgin, but not a virgin to the industry by any measure, financial analyst and commentator, Dr. Gary Shilling. He's the president of A. Gary Shilling and Company, the editor of A. Gary Shilling's Insight, and author of the book, The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. Dr. Shilling, so good to have you on the show here.
Glad to be with you.
So, we started the year thinking that the markets were going to hit more record highs, things were going well, the economy was going well, and although they did eventually hit record highs, boom, on comes COVID-19, March hits, and everything changed. What was really the most surprising thing to you about how the economy or the markets reacted with this whole COVID-19 crisis?
Well, obviously the virus is the most surprising thing. Nobody really saw that coming. Matter of fact, my wife and I were in Southeast Asia right after Christmas and went to Hong Kong in mid-January. And when we got back, we were worried a little bit about it because, but that was the first time that the virus was really extant. But I think the big surprise was the speed with which this spread and the universality of the whole thing, and also the fact that there is no vaccine. And what we're seeing is that every time economies, cities, states try to open up, return to more normal business and consumer conditions, then you get another wave of the virus and they have to consider locking down and so on and so forth. And of course, one of the problems is that we Americans are not terribly disciplined. It's not like the Chinese where they have ways, and some of the European countries, which are much more willing to follow orders.
We're the land of the free and the home of the brave, as I said, and that's a double-edged sword, I guess. But economically, though, as far as the stock market, you probably weren't surprised at the economic carnage in the second quarter. You probably weren't surprised about the, almost 40% market drop in March. But were you surprised about the speed of the recovery versus whether it's economic or just the stock market recovery we've seen so far?
Well, not really, because what we've seen historically is that when you get massive amounts of money dumped into the economy, markets respond. We saw that after the financial crisis in 2008. The Fed went into quantitative easing and stocks took off like a scalded dog, even though the economy had the slowest recovery of any in the entire post-World War II period. So the only thing that investors in stocks are really concerned about is money being pumped out in Washington, and what the basic economy does is much less of concern to them.
Right. Don't fight the Fed. Isn't that right, Jeff?
Don't fight the Fed. Yeah.
Don't fight the Fed.
That's in terms of stocks. That's not in terms of the economy. And of course, the Fed is very frustrated because the Fed can raise and lower interest rates. They can buy and sell securities, and they're buying everything in sight now, obviously, even fallen angels, corporate bonds that previously were investment grade that are now junk. But that doesn't, it's a perennial lead the horse to water, the economic horse, but you can't make them drink. But that has been a little concern to equity investors.
It seems that way, doesn't it, Jeff?
It really does. And, Dr. Shilling, what is of real concern to a lot of investors is what's going to happen with this election and how is that going to affect the markets. And in all fairness, I just found out today that President Trump has the second best stock market as a sitting president since Bill Clinton. Who would have thought on November 6th of 2016, Dow futures were down 800 points, and it's been led by our biggest and brightest companies since that date. What is your take on that?
And Dr. Shilling, we have 30 seconds in this segment.
There's a big difference between investors. Stocks are owned by a relatively small number of people in any size. Yeah, a lot of people have them in their pension fund portfolios and so on, but stock ownership is relatively narrow. And you got a lot of people out there who are obviously out of work on short hours, worried about their jobs, big layoffs continuing. So you have a bifurcated situation in many ways.
And Dr. Shilling, we need to take a commercial break. We want to hear more about that in just a minute. So if you stay with us, we'd love it. And you stay with us too. We have much more coming up from the great mind of Dr. Shilling in just a moment. We'll be right back. Run out of time to bring back my co-host Jeff Small, as well as a new friend to the income generation financial analyst and commentator, Dr. Gary Shilling. So Jeff, at the end there, you were getting the political side of it a little bit, asking some questions. So I'm just going to hand the floor over to you.
Sure, and Dr. Shilling, we got cut off at the break, but I wanted to hear what your take was on why President Trump has had the second best stock market as a sitting president since Bill Clinton in the 90s during the dot-com boom. And we know what the dot-com boom was all about. That was a great time for no matter who the president was, but Bill Clinton had very unique economic policies that facilitated that growth. But why has President Trump, why has he had the second best stock market as a sitting president? What's your take on that? If you could elaborate as to the reasons why, I'd appreciate it.
Well, yeah, I mentioned in our first segment, I think it's simply because you've had so much monetary and fiscal stimuli coming out of Washington. They've been, dumping money out of helicopters, buying all securities and in sight, all kinds of supplemental income. And of course, it's what's kind of surprising, they haven't gotten together on another round of fiscal stimulus, more money being sent out to individuals, people laid off, et cetera, before the election. But that's what I think is really sustaining it. And you see this on a daily basis. Whenever it looks like they're going to get together on a new stimulus program, the stocks rise. When there's a delay, stocks fall. That's the only thing that equity investors seem to be concerned about. And the rest of the country is different. Now, of course, it's the rest of the country that elected Trump in 2016. It wasn't the liberal-dominated East and West Coast. It was the people in the center, and those are the people who have been suffering. So that's his constituency. Now, whether that's going to be strong enough to carry him through this time or not remains to be seen.
Yeah, it's going to be interesting to see what happens. I mean, we couldn't trust the polls in 16. We don't know what the polls say today. But for today's talk, we're really going to stay apolitical. But what do you think will happen going forward? Will this election be benign on the markets in 2021? When we see stimulus kick in after the election, because it looks like that's what's going to happen, what is your take on the markets going to be, whether it's a Democratic-driven policy economy or a Republican-driven policy economy? Is that going to be benign? And how's the market in your forecast going to do next year?
Well, you've got issues on both sides. Trump was elected largely on a protectionist policy. He blamed the malaise on immigrants and imports. And if he is reelected, and particularly if he shows any strength in Congress, he probably will go for more protectionist measures, and particularly against China. Now Biden is in the same boat. They're really rivaling to see who can be tougher on China. But the big difference there is that Biden wants to undo all the tax cuts. He wants to increase taxes on the higher income people with assets, redistribute income downward. Basically, it's much more a liberal kind of approach. Again, what he would be able to carry out as president is questionable. If I had to flip a coin, I would say that Biden's election would create much more uncertainty for the economy than Trump. Trump, at least, people are used to. Whether you like him or not, you kind of get the feel of how this guy operates and what he does next.
Gee, Dr. Shilling, I've always, reading insights and everything, I've always felt like you were a little bit more left-leaning politically, but it seems now like you're. Am I hearing you right? Sounds like you're coming just slightly more to the right, or am I misinterpreting?
Yeah. Well, you've got. The interesting thing people don't realize is that it's the Electoral College that elects the president. It's not the popular vote. And every state has at least 3 electoral votes. You take Wyoming, they don't have enough population to rank one representative, but the Constitution says they get 1, and they have 2 senators. So population-wise, a state like Wyoming is way under the average, but yet they have a lot more clout, and those are many of those states in the middle of the country. So the Electoral College, and that's what that's what politicians run for. They don't, Biden isn't going to worry about California or New York. Those are wrapped up. He doesn't worry. Why waste time there? They're going after the battleground states, and there are a lot more of them now than there were in 2016, which makes it obviously a much different election. But bear in mind, in 2016, the popular view, certainly supported by the media, that was Hillary with a shoe-in and Clinton didn't have a chance. I'm sorry, Trump didn't have a chance, but it proved to be quite different.
So Dr. Shilling, 30 seconds left. Best piece of advice that you have investment-wise through 2021 for people retired or approaching retirement?
I think you need to be very cautious in your investments. Now, we do manage money, and we have a really risk-off portfolio right now. We think that there could be that this recession could stretch into next year. The virus isn't going to go away. And so we are very heavily invested in treasuries, treasury bonds, which have been my favorite since 1981 when I said we're entering the bond rally of a lifetime. And since then, treasury bonds have outperformed the S&P 500 by 6.5 times.
Right. So it sounds like you're expecting a pretty good pullback on the stock market then. If you're going treasuries,
I think the
risk
stock
off.
market is, I think, very expensive and very vulnerable.
Great. Dr. Shilling, we need to leave it there for now. Thanks so much for being on the show. We really appreciate it. It was great having you.
Glad to be of help.
And you stay with us. We have much more to come in a moment right here on The Income Generation. We'll be right back.